I said, why don't you have an RSP? And she said, I talked to a bank manager 20 years ago
Yes.
that told me that RSPs were a ripoff because I was going to have to pay tax on that money when it came out.
I would have started that conversation with like, how much money do you want to pay to the government of Canada?
Hello, I'm Matt, and that's Nate. You're listening to Money Questions. Our second episode is called Acronym Decoder Ring, RSPs, TFSAs, OMG, WTF. In this episode, we'd like you to leave with a basic understanding of when to use what account type and why certain tools aren't necessarily better than others, just more appropriate.
Yeah, and also set you up for success early on in the year.
Nathan, have you ever seen a doctor's office list the tools that they utilize to care for people? Like, for example, a sign that reads doctor's office, stethoscopes, syringes, gauze, tongue depressors, etc. Have you ever seen that?
I have not.
You've not? Nope. And have you ever seen a contractor's vehicle list all the tools that he's got inside his work truck? You know, like hammers, nails, screwdrivers, air compressors, saws?
No, they usually talk about thefts that have happened from said work truck.
That's right. Yeah. Well, and I think that's because that people don't engage those professionals for the tools that they have, but it's more so it's what they can do with those tools, right? You know, for a contractor, you want to know if they can get a project done. Now, unfortunately, we have both seen financial advisors' offices that list RSPs, TFSAs, GICs, and insurance. So they list the tools that they use and not necessarily what those tools can be used for. Anyways.
Yeah, like the whole industry is guilty of it. Yeah.
Leading with product recommendations is usually putting the cart before the horse. And I might argue that if someone leads with a product recommendation before asking questions about you and your situation, that you should maybe get up and find another advisor.
Or proceed with caution.
No, the topic that we're diving into today is sort of trying to decode the alphabet soup that are the acronyms that people hear about at this time of year, right? So
yes,
we hear about RSP season.
Warning, financial jargon alert. RSP stands for Retirement Savings Plan, which is an account that helps Canadians save for retirement.
Which is an acronym for Registered Retirement Savings Plans.
Yeah.
Which is a tool used for your future self.
Mm-hmm. But RSP season, like what is that, right? People hear the term RSP season. It's a bit of a throwback. It doesn't apply as much today as it once did, maybe.
Yeah, I would echo that too, I guess. But it's, yeah, at the beginning of the year is when you should be doing all your year-end planning.
Yeah, exactly. So we talked a little bit about calling this episode year-end planning.
Yeah,
at the beginning of the year.
Yeah, in January.
A lot of financial institutions and newspapers will put up year-end tax planning tips, but the fact is, if you haven't done it by the end of the year, sometimes it's too late.
Yeah.
And so the best time to plan for the end of the year is at the beginning of the year.
Usually you have a game plan before you start said game or said task. It's sort of like reading the directions before you tackle the IKEA furniture. You should do that before you do it. Otherwise, it's just more beers of work.
It's true. IKEA is a 4-letter word in my household.
But it sort of is scary and jargony. So like in me prepping for this episode, Matt's like, don't worry about it. I have this list of questions. And you know when I like walk by your office or drag you into my office and I ask you all those questions, I'm just going to do that and put a microphone in front of you.
Yeah.
So that's what we're going to try to accomplish because we come across all these conversations like in our day-to-day work life, and they're relevant to everyone.
Yeah, I mean, what we're trying to do is, I guess, impart some wisdom around all of the different acronyms and all of the different jargon that you typically hear at the beginning of the year.
Mm-hmm.
So we're going to focus a little bit on a few of those accounts, RSPs being one of them.
Yeah, even just to start out, there's a lot of things that you can jam underneath those particular acronyms because all they are registered accounts in the eyes of the Canadian Revenue Agency. You can put pretty much anything sort of in the investable universe in a registered retirement, a savings plan, a tax-free savings plan, a first-time home buyers plan.
Close. Yeah. It's close
I
enough.
can never get that acronym
First home
right.
savings account.
First home
whatever.
savings account.
Same deal. When you say registered with the CRA,
Yes.
what do you mean by that?
What registered with the CRA is so every Canadian is entitled to RRSP contribution room based on their earned income in the previous year. So that's something you're entitled to, and it's a tool that can be used in combination with all the other deductions you see on your pay stub. Like on your pay stub, you'll see, what's this CPP thing I'm paying into?
Warning, financial jargon alert. CPP stands for Canada Pension Plan. It's a program that provides a monthly, taxable benefit to replace part of a person's income after they retire.
Like that's the Canada Pension Plan. And as an employee, you're required by the government to pay into that for your future self, as well as your employer has to kick in for all conversation, like the other half. So like that's the basis of like as you've entered your working life, like that's the start of your retirement savings.
That's it. What the CPP you mean?
CPP.
Yeah, right.
CPP.
Yeah.
Old age security is an OAS is something everyone gets. Like if you're Canadian, that's probably something for a different conversation because it's not really a tool that we use.
Yeah.
It's something that we use to plan around.
Gotcha.
Yes.
Yeah. Well, I think we should talk about the various account types.
Yes.
And then we can dive into how they're how they're similar and how they're different.
Sure.
Right. So you've got the RSP, money goes in, you get a contribution receipt, right? It goes in there. You have a TFSA.
Money goes in, you don't get a contribution receipt.
Right.
Which is really confusing.
Yeah.
But with the tax-free savings account, there's no impact on your April 30th tax filing from 2024. But what does happen is the money that you're contributing, you're only allowed to contribute so much. So if you were at least the age of majority back in 08 or 09, you're allowed to put $102,000 into those accounts in lifetime contributions. There's a bunch of different ways that like money in, money out. You're like over the years, you're still allowed to have, as of this year, $102,000 in deposits into those accounts. But the main purpose of those types of registers accounts is it's another tool used for a long-term investment growth. Early on in like a lot of folks, you're just, I always bring it back to cash flow. Every time I'm like sitting down and talking to someone, I'm like, how's the monthly cash flow situation? What do you currently have in place for emergencies? What happens if the car doesn't start and you have to go buy a new car? Where does the down payment come from? Mm-hmm. Like, what's the number in your bank account that makes you feel like you can handle most emergencies? And for a lot of people, it's between like, there's tons of financial professionals that say it's between 1 and 3 months of your earned income. Mm-hmm. Just to have set aside for all of the just in case emergencies.
Fair
a
enough.
lot of the time. But like a lot of the time, if you don't have access to a low interest borrowing solution, the tax-free savings account isn't used as an investment account, a long-term investment account. Mm-hmm. In those situations. It's exactly what is it? It's a tax-free savings account. So it's used over a 1 to 3 year period. It's holding cash and high interest savings, and it's set aside. It's a little hard to reach at, but it's for emergencies, earning interest tax-free. And that's usually where we start.
All right, so let's get to the Q&A, Nathan, because we can dive into some of those, or those nuances can be explained in detail as we talk about the account types, right? But right off the top, you explained what an RRSP is. It's tax deferred, meaning that any money that grows in there, you don't get a tax bill on every year. Just to contrast that against having money in investments that's not in one of those accounts. If you have money inside like a mutual fund or a stock and it pays dividends in a non-registered account, you get a tax bill every year for that income. In the registered account, you do not. So you get to defer all the growth inside an RSP. So that's one kind of characteristic of an RSP. Contribution receipts were another.
Yes. And a lot of the criticisms with registered retirement savings plans is when you get 20 or 30 years down the road and retirement sort of knocking on the door, the money coming out of those plans, it doesn't really come back out in a tax efficient strategy. It all comes out as it's taxed the same way as interest income or employment income. And that's taxed at higher tax rates than dividend income or capital gains.
Right. So to bring that full circle with an RSP, let's say you're in a, just for argument's sake and for clean math, we'll say you're in a 25% tax bracket, which I know doesn't really exist, but there's a 25% tax bracket, and you put $10,000 inside an RSP. The government gives you back $2,500 of tax money.
How much did I make that year? What's my taxable income? Did I make 50? Did I make 60, 70?
Those are weeds I wasn't wandering into, but if we want to go there.
Well, you're asking me a question where the answer is going to be, it depends.
No, but I'm just trying to give an overview of the RSP to someone that doesn't understand them without confusing them.
Absolutely. So let's say at the end of the year, you look at your December 28th pay stub and you made $50,000. Yeah. And you're like, I have a little bit of money in my bank account. I have some money set aside for the emergencies, the shits, like that's all looked after.
Yeah.
Hey, I'm putting a little bit of money, like my money's going into the Canada pension plan. I have some additional incentives through my employer through a pension or stock purchase program or a bunch of other acronyms. So an RRSP, you have an extra $1,000 that you're not going to miss. That $1,000 goes in to said account prior to my birthday, February 28th, or March 1st. It takes your taxable income from that $50,000 down to $49,000. So you're saving the tax on that contribution. For the majority of Canadians, this results in some sort of tax refund.
Right. If you're not self-employed and taxes are deducted from your paychecks and you're always square with the CRA, then this will result typically in a tax refund of some kind. Right. In that case, if we use my imaginary 25% tax, right, you'd get $250 back in taxes for your $1,000 contribution.
Correct.
Right. So you get that back. Right. So that's sort of how the RSP works on the front end. Right. And so, but you also had another option. You had the TFSA.
Yes.
So let's walk through the same situation with the TFSA. It's a lot simpler, right?
So $1,000 goes in.
Right. After tax dollars.
Tax dollars.
Yeah.
No impact on your tax return.
Right.
And then it grows tax free.
That's it. Right? Yeah, perfect. Yeah, that's it. That's the difference.
Did I nail it?
You nailed it.
I didn't read the show notes on it.
And then FHSA.
There's a tax deduction for that.
Right. So these are the three account types that typically people are considering these days at the beginning of any calendar year. RSP, TFSA, FHSA. People argue about what's better. The answer is...
I'm overwhelmed with acronyms.
It depends.
It depends.
Right? Yeah.
I tend to look at each individual case from just sort of like the time horizon of said financial need or goal. And then that dictates what tool to use.
Yeah. And in the same vein, I guess it's the first question to ask when you're asking yourself, well, what account type should I use is what are my intended uses for this money? Right? Intended use, that's the starting point. Am I saving for retirement? Am I saving for a house? Am I saving for a vehicle 10 years from now? Right? Those could dictate 3 different account types.
They all work to accomplish that goal, but some account types work better than others in certain situations.
So if we think about all these funds going into these accounts at the beginning, they've got all their different nuances, but they also have nuances when the money comes out on the back end, right? And so when the money comes out on the back end, yes, you got your tax deduction when it went in, but on the back end, you're now paying tax on the money that's coming out. The government essentially wants the taxes they gave you back when you put the money in, plus the growth. Yes. Plus a portion of the growth, right? With the TFSA, they're saying, well, those are after-tax dollars that went in. You're going to get all the money that comes out on the back end, right? And with the FHSA, you get the contribution receipt up front, which is great. Yeah. And then you get the benefit of a TFSA if it's coming out for a home purchase. You don't have to pay tax on it. So an anecdote that we recently encountered was a couple, and they both have really nice pensions.
Yes,
because they worked for the Coast Guard, right? And we had the captain sitting there saying, "I wish I had never saved this money
in an RRSP."
Because now I'm
never going to be in a lower tax bracket.
I'm always going to be paying taxes. I've got this big pension, and all this money is coming out on top of my pension, and I wish I had put more in a TFSA. Yeah. And he's not necessarily wrong, right? He may have been better off knowing that he was going to have this big pension to have saved more in TFSAs. Yeah. But I think the point that a lot of people forget is that when they put that money in, they got those taxes back.
Yes.
And 30 years later, you sort of forget that. And we encounter a lot of people that don't necessarily take the tax savings that they got back when they put it in. They don't take that and put it back into their retirement accounts. They take it and do other things.
No, they deal with not the emergencies, but they deal with the top of mind monthly expenses. Like they're filling up an oil tank, they're ordering a couple cords of wood, they're paying for their insurance up front, so there's no financing costs to it. And that's how they budget. They're like, I'm counting on my tax refund to do this thing in the beginning of the year.
That's it. Now, we know, just because of our line of work, that the most optimal thing that you can do with the return you get from an RSP contribution is to turn around and put it in your RSP. It's really, if you want to maximize the impact of an RSP, you're going to turn around and take that money, you're going to put it back into an RSP. Yeah. You'll get another return on that money again.
Yeah.
Right?
But just that, another way to think of it is you're taking $1,000 and putting it into as an RRSP contribution, and then you've just turned that $1,000 into $1,250 through the tax refund. So that's a 25% annualized rate of return, which is incredibly aggressive. Some people saw that last year, but it's what you do with that money going forward. And do you need it to address a short-term need? It's okay if you do, but if you don't, how do you best use that refund or you tax plan in order to benefit your future self?
So I think we've kind of touched on, what they are, how they're different. You talked about tax returns a little bit. Maybe we should kind of dive into that. Just briefly, just because we do have some people when they come to see us for the first few times that treat their tax refund like a savings plan.
That's fair.
You're right. There's people that will overpay their taxes all year because they like getting the tax return at the end of the year.
Yes.
And so the question that we ask sometimes is, if the government of Canada came to you and said, "Hey, do you mind lending me $3,000, but I'm not going to pay you any interest and I'll give it back to you next year," what would you say? Most people would be like, "I'm not doing that. Are you kidding me? I'm not giving you money for free for a year."
All those people use it as sort of a forced savings vehicle because you can't call up the Canadian government and say, you're like, all those taxes that I overpaid that I haven't filed the return on yet, can I have some of that money back? It just doesn't happen. They won't give it to you until you file that return for that year. Yeah. So it's a very deliberate deposit-only savings vehicle, and that's what I understand. That's what people use it for.
Yeah.
Because they don't trust themselves with some money in their checkings and savings account.
Mm-hmm.
But that's what they use it. But essentially, with appropriate tax planning, the goal should be to have a zero balance owing and a zero refund. And if it's within a few $100s, like that's really good.
Yeah, perfect.
This is the part of the show I was like sort of dreading the most.
Yeah.
Because I know Matt's accumulated a bunch of ridiculous scenarios.
Yeah.
To try to catch me off guard.
All right. Well, no, I'm not trying to catch you off guard. I just think it's illustrative. That's all. I recently had a meeting with a client. She was putting her 2025 TFSA contribution of $7,000 into her account. And we were sort of updating all of her KYC information.
Warning, financial jargon alert. KYC stands for Know Your Customer. It's a process that verifies a customer's identity to prevent illegal activities like money laundering and fraud.
Know your client. That's the jargon. That's just the fact that advisors have to know their clients, which is probably a low bar. But anyways.
I digress.
Yeah, I digress. I asked her how much she had in liquid assets. That's just one of the questions we ask. How much do you have in liquid assets? Like cash on hand or cash in the bank. How much do you have in non-liquid assets? That's real estate. That's registered accounts. How much do you have in liabilities? That's debts, mortgages, things like that. Anyhow, we're updating her net worth. Those are the three components of your net worth. And I asked what she had by way of liquid assets, and she said she had $175,000 sitting in her checking account. And I just
I hope you unpack that.
Yeah, oh yeah.
As to why.
I almost fell off my chair, and I said, "Why do you have $175,000 in your bank account?" She said, "Well, that's where else am I going to put it?" I said, "Well, you don't have an RSP." Like, she's a relatively new client. We started with the TFSA. I inherited this client, meaning that I took her over from another advisor. And so, still getting to know her and everything. And I said, why don't we put some of that into an RSP? What's your annual income? Her annual income is $150,000 a year. She's self-employed.
Yep.
Right. And so she's faced with a giant tax bill at the end of every year.
Yep.
She pay, or on an installment basis. But I said, why don't you have an RSP? And she said, I talked to a bank manager 20 years ago that told me that RSPs were a ripoff, because I was going to have to pay tax on that money when it came out.
I would have started that conversation with like, how much money do you want to pay to the government of Canada?
There you go. Right. So if you earn $150,000, roughly how much tax are you going to pay, Nathan? Roughly. I'm not going to hold you to the number. Live math.
Marginal or average?
Average.
I don't know. It's a little over 30%, I think.
Right. A little over 30%. So $45,000, we'll call it.
Yeah.
Right, $45,000 in taxes on our $150,000.
Yeah.
And so let's say, for example, let's keep the math clean. Let's say she made a $50,000 RSP contribution. Does that work for clean math?
Yeah. Well, her marginal tax rate, I think it's like 43%.
Right. So that meaning marginal tax rate, meaning
the highest tax bracket.
The highest tax bracket, right?
Because it's important to sort of get this out there that an RRSP contribution benefits you in those higher tax brackets. So in Canada, we have a tiered tax system. So you pay so much tax up to $20,000, $40,000. The list goes on. It's a little more nuanced than that, but that's the gist of it. So when you make $20,001, that $1 is in a new tax bracket. When you make $40,001, you're like, that dollar is in another tax bracket.
Yeah.
So when I just asked Matt, like, what's the average? You take all those brackets and you take the average.
Right. And just to butt my nose in there for a second.
Yes.
I think a lot of people think that, tax brackets work back to $1. So to your point, right? Like the marginal tax rate is your highest tax rate. So you don't pay any tax on about your first $15,000 of income.
That's fair. Yeah.
Right. And then on the next $20,000 or $30,000 of income, you may pay between 15 and 20%. And on the next $50,000, you may pay 30 to 40%. Those aren't the exact figures, but you get where we're going with that. It's not like if you cross a threshold, your taxes are higher back to $1. It's just on that chunk of income.
Yeah. So that for that particular individual, it's just like if those short-term and midterm needs are met with the savings goals and the emergency savings, I would look at what she currently has in place for a long-term retirement or saving strategy.
Mm-hmm.
If there's nothing, then there's a lot of validation in an RRSP contribution that brings her all the way back down through that highest tax bracket that she's hanging out in.
Great. Right. Yeah, absolutely.
But because she's going to get 43 cents on the dollar back as a tax refund, it's a bit different when you're self-employed because it's just a smaller check that you have to write at the end of the year.
Mm-hmm.
But that's a whole lot of math that we don't need to talk about.
No, and that's, most people
Yes.
have taxes withheld. She was unique in that way. It was the self-employment was there.
Yeah.
But yeah, this is what needed to be illustrated to her was that that $150,000 or, 100 whatever I said, that was sitting in her bank account was not serving her as good as it could have been.
And I also think it's worth pointing out that with all these registered vehicles, getting money into them invested instead of just saved within high interest savings, like getting them invested, time's your friend. The longer, the better. Just slow compounded growth makes probably the biggest difference to an individual's retirement.
Well, yeah, and I think in her case, I asked her if she planned to retire one day, and she said, yes, I'd like to stop working one day. And I said, when you stop working, do you think you will be in a lower average tax bracket than you are today? And she said, well, yeah, I won't be working. I won't be earning anything. So if she puts money away and gets 43% of it back today, but pulls it out in 15 years and only has to pay 17% on it, she's really benefited from the difference between when she put it away and when she's pulling it out. And I think really that comes down to the crux of when we consider an RSP to be more optimal than a TFSA.
Yeah. So
right?
for not the average household, but for a lot of households, during their working life, they're in the high, they're in their 20s to 30s for average taxes paid. But in retirement, those tax rates tend to drop at least 10% from income splitting and efficient tax planning. So when you're drawing out of these registered vehicles like the RRSP, you're taking that money out 20 or 30 years down the road after it's compounded tax deferred for that period of time, not paying 30% tax, but you're usually in the teens, depending on your lifestyle in retirement.
Fair enough. So again, in her case, she's got this full TFSA. The next best account type is probably not the checking account.
Yes.
Especially when you're sitting on, $150,000 plus of liquid assets, right?
But she can hold that same cash in the RRSP.
Absolutely.
But get a tax deduction to do it.
Right. We could grow it by 40%, essentially.
And then she put it back in the RRSP.
And then she could put it back in the RSP. So in this case, the task is kind of illustrating that for her, but maybe putting a spotlight on the fact that she's saving a lot of tax dollars up front, despite the fact that she will have to pay taxes when it comes out. And the delta between those two taxes, saved and payable, will be big enough to make it worthwhile.
Yeah. So we've illustrated there are a lot of variables.
Yes, right.
And there's a lot of it depends.
Yeah.
But it's important to sort of talk through all the scenarios and what you're trying to achieve within your household.
And I think the conclusion here is that it's not a scam. RSPs are not a scam. They're very transparent. In fact, you can...
Well, the stuff you were sending me last night on text.
Yeah.
That was a lot.
There's a whole corner of the internet that argues that RSPs
that you spend too much time in.
Yes. Yeah. Oh, yeah, for sure. Yeah, I spent way too much time there.
Yeah.
It's amazing. It's like watching train wrecks, right? Yeah. Just because it I think it leaves a false impression of the benefits. I think you can get caught sometimes in a less than optimal situation in regards to how you've saved money. But the problem is, all of the variables that we're talking about and we're considering today, there's a possibility that they all change at some point in your life.
And I think the most important part for just like the Canadian household is to take a little bit of time, be educated, be informed, like ask really good questions, because there's a lot of good solutions to the problems you're presented with in January.
Mm-hmm. Yeah, I think what we'll do is in the notes underneath this show, we're going to provide a few more resources. There's some really in-depth and great resources available to people out there, right? And I would also say that, don't be afraid to pick up the phone and reach out to, your friendly neighborhood independent advisor.
Okay.
Right?
That's fair.
Yeah.
Ask some questions.
Ask some questions. Yeah. Ask what's best about your situation and why they're making the recommendation they're making.
The comments contained herein are a general discussion of certain issues intended as general information only and should not be relied upon as tax or legal advice. Please obtain independent professional advice in the context of your particular circumstances. This presentation was prepared by Matthew McGowan and Nathan England CFP for the benefit of Matthew McGowan and Nathan England CFP, mutual fund representative with Evangeline Wealth Management, a registered trade name with Investia Financial Services Inc., and does not necessarily reflect the opinion of Investia Financial Services Inc. The information contained in this presentation comes from sources we believe reliable, but we cannot guarantee its accuracy or reliability. The opinions expressed are based on an analysis and interpretation dating from the date of publication and are subject to change without notice. Furthermore, they do not constitute an offer or solicitation to buy or sell any securities. Mutual funds are offered through Investia Financial Services Incorporated. Commissions, trailing commissions, management fees, and expenses all may be associated with mutual fund investments. Please read the fund fact sheet or prospectus before investing. Mutual funds are not guaranteed, their values change frequently, and past performance may not be repeated.
You've been listening to a Podstarter production.